Good morning to this fourth sequel of the Sunday series, Sunday with the Valuation Experts, organized by the Valuation Standard Board. The last three episodes so far cumulatively have clocked gross attendance by over 20,000 attendees. Today we are having this program on the topic minority valuations, often unsatisfactory, which is going to elaborate on valuation methods and challenges in valuation of minority stake. We have the distinguished panel of CA Anil Bhandari, Chairman Valuation Standard Board, CA MP Vijay Kumar, Vice Chairperson, steering these discussions. Also, we have the distinguished presence of CA Balasubramaniam, a registered valuer who is deeply engaged with ICAI with his knowledge enhancement initiatives. Possibly with today's discussion, we'll have more clarity on rather infamous terminology, minority squeeze out under corporate restructuring, as have been so far made out in invocation of Section 66, reduction of share capital, takeover notification, Section 230 and Section 236. To address these challenges around minority valuations, the statutory construct has provided for independent valuation by the registered valuer to protect minority interest, and will see application of VS 301 and 303 for credible valuations. As while valuing the entity, the value of control is the key determinant in arriving at value. With these words, I welcome this distinguished panel and all the attendees to this program. And with this, I request CA Anil Bhandari ji to further steer this session. CA Anil Bhandari.
Well, very good morning to all our viewers, and thank you, Rakesh ji, for laying out, our discussion points today. And yes, I think the last 2 or 3 sessions have been fantastic. And every session, I think we've had more than 7,000, 8,000 odd members attending. And also, I've been very impressed with the number of questions that members have been asking in all the sessions, which shows that this is highly interactive and engaging session that we are having so far. I think last time also we had almost 250 questions which had come up, so which is again very, very impressive. Now, this topic minority is essentially, of course, tricky and very interesting personally to me. I have sometimes started to feel that minority is actually becoming majority. So that's an interesting way to look at it. And I'm sure when we get into this valuation, there will be a lot of aspects that we would have to kind of, deal with during the times of minority valuation. So not taking too much time as usual, we would get into it and deep dive. I would, of course, welcome my colleague, MP Vijay Kumar, who also happens to be the Vice Chair of the Valuation Standards Board. I think without him, it would not have been possible for us to do these sessions very, very effectively. And of course, our colleague in the Institute, Sarika, as well. And welcome, TV Balasubramanian ji. Thank you so much for taking out your time. I've had some fantastic comments coming from MPV just before we started this, and I'm looking forward to, of course, have an engaging session with you. So thank you, and on to you, MPV. Thank you so much.
Thanks, Anil, for setting the context. And as we have done in the earlier sessions, we get straight to the topic for discussion. Balu, hearty welcome. Good to interact with you again after quite some time. So getting straight to the topic, Balu, maybe more from a little setting up the context, and also the fact that we have these valuation standards where we had the benefit of your expertise also in evolving them. Are there any separate provisions in the valuation standards for valuation of the minority stakeholders, minority shareholding transactions?
Yeah. Morning, y'all. Thanks for all the kind words. So first and foremost, to give a background, there is no specific separate standard or guideline which has been brought out, not only here, but internationally also under various standards. There is no specific separate guideline or standard which you can say has been brought out for the purpose of minority shareholding evaluation. However, just to give the setting also, I thought I will just elaborate a little more on this. If you really look at the history of shareholding and share capital and the thing, probably in the early days, majority had all the say and minorities were really put at a disadvantage, and probably they did not have a voice, right? So anytime the minority shares were to be sold or to be taken over, etc., they were at a disadvantage. That was the starting point. And over a period, a lot of legislative changes have come about, which have brought about a lot of changes to ensure that there are enough laws to protect minority interest, etc. And based on that, there have been case laws also, quite a few case laws which have come across even in India, where there have been certain settings which have been taken. But the core issue of a couple of issues, which we will deal with probably in more detail as I go into core issues of difference between a majority shareholding and a minority shareholding on certain aspects have not been dealt with in these case laws. So I expect quite a lot of litigations to come up in future, and probably some path setting litigations to happen in future in due course. If you look at the current company law structure also, you will find that in some places it uses the words at a price to be determined by a registered valuer, very clearly indicating that the fair valuation or the valuation which the valuer is going to arrive at is going to be the basis for the transaction, such as in the 236 squeeze out provisions, etc. There are many other places it only says a valuation report needs to be produced. Like, for example, when there is a fresh issue of shares, etc. So there is a dichotomy in terms of how it is provisioned even in the Act. And clearly it lays emphasis in certain cases where it emphasizes this thing that the transaction must happen at the price, or at least at that price, to the benefit of the certain section. For example, in 236, to the benefit of the minority shareholders. So having set this background context, if you really look at the valuation standards, be it in our own valuation standards, we have two valuation standards which are primarily used when we talk about equity valuation, 301 and 303, right? 301 is what people normally tend to look at when they look at equity valuation, which is actually the standard itself is business valuation standard. My own view is we have to take a look at the case, and there might be many cases where it would be more appropriate to deal with this under 303, which is financial instruments, rather than under 301. 301 emphasizes quite a lot on business valuation, whereas 303 purely considers that a financial instrument. Now, if you look at India also, there are certain unique things you will find, especially there are quite a few large private companies, or they may be public companies in terms of the company law structure, but essentially they are privately held companies where a small fraction of, say, less than 5% shares for some historic reasons are held by hundreds of people. Now, this is something which we see quite a lot in the Indian context, for whatever be the historic reasons. Now, these are not companies which were listed and they are getting delisted. These have been companies which have been outside the listing forever or for a long time to think of. It is just some historic reasons. There are some shareholders who are very, very small shareholders. They don't even cross the 10% mark to say that they have this thing. So we need to have a differentiation in the valuation of minority shares on a case-to-case basis, depending on what continuum they are into. So this is something which we will be seeing more as we discuss. So my opinion, there are cases where we should disregard 301 and we should go with 303 as the valuation standard for the purpose of minority stake valuation, considering the facts of the case. For instance, in a case, let's say like this, where there are hundreds of shareholders who are holding in total less than 2-3% of the company shareholding, due to some historic reason. Now, if the company is considering a squeeze out under 236 or through a capital reduction, selective capital reduction, whichever way, to essentially give them a forced exit. Let me put it as a forced exit, because there can also be buyback schemes, etc., which are optional. Now, obviously, the pricing will have to be different between the two. When you are giving a buyback, it is purely optional. The person could still continue as your shareholder without this thing. Whereas in the other cases, it could be a forced exit being put on him. There may be a need to not look at it as a 301 valuation and probably look at it more under 303. This is the key thing. And similar two standards are available under international standards also. If you look at it, there are separate financial instrument standards which are available vis-a-vis a business valuation standard.
So, MPV, I just wanted to again ask a very foundational question. I'm saying, how is your share different than mine? I mean, assuming you're in majority and I'm in minority.
Okay. So,
where does this start from? I'm saying, where does this start from? This entire discussion, financial instrument is an instrument, an equity share is an equity share, whatever. I'm saying, where does this fundamentally start from? That your share is different than mine?
Sure. I'll let Balu to respond that.
Yeah.
But it's a very interesting question. And
no, actually,
Balu, just a second before you can respond to him. In fact, Anil, both of us have the same approach to many things in life. And I've always believed that there's no need for formally introducing someone. When they speak itself, you get to know who they are. So we just got a good introduction of Balu through the way he answered the first question as to who he is on the subject. So Balu, two things you brought out very nicely. One is the fact that under the Companies Act, for most of it, we only require a valuation report. Whereas when you do a squeeze out, it's actually a valuation where a transaction needs to be done only at that particular valuation at the minimum. So beautifully articulated. And more importantly, I like the distinction between 301 and 303. And I think that basically will actually help us answer what Anil raised actually, because it's a share, whether it is under 301 or 303. But I think the shares have various rights attached to it. And those rights actually get valued when you move from 5% to 10% to 26% to 51%. So the rights keep getting added, and that's where valuation keeps coming in. So thanks for the clarity, Balu. You said the context very well. And I also like the way you explained on the minority, the extent of holding. There are many people who have shareholdings which are historical, these are 100 shares, 200 shares. Together, it doesn't even accumulate to 3%. They are also called minority. And somebody holding 20, 25% is also called as minority. So both of them cannot have the same approach towards valuation. So thanks for bringing out the clarity. Over to you, Balu, to respond to what the chairman said. Please go ahead.
Yeah. I think you caught the key crux of it very nicely. Minority is a single word which actually defines quite a lot of holdings, like you were mentioning. So there is no such defined cutoffs. But from a legal perspective, from a company laws perspective, at least we know that the rights keep changing at various levels. So the first is, so that is why I said, it is very, very important to study the shareholding pattern and the structure of the entity to determine the right valuation approach to take in a given company. For instance, if I am myself holding 5% stake in a company where the balance 95% is held by, say, 3 people, whereas I am holding 5%, it could be different from a case where 95% is held by 3 people and 5% is held by 500 people. So, because if you look at the rights which are available under the Companies Act, the moment I'm a single shareholder holding 5% and the balance 95% is held by 3 people, I don't have any right to even go in for operation mismanagement, etc. in the normal course. in the normal course, right? So if it talks about 10% threshold or 100 members or 10% of the members, etc., as a threshold, very easily the other 3 people can make it held by 8 people, so that they are out of 8 more people, so that they are out of the 1/10. Very, very simply, it can be structured and this thing. At the same time, holding 5% together, assuming the 95% shareholders cannot change their structure though so easily because of various commercial and practical perspective. I am over the threshold because I am more than 1/10 of the shareholder. So I have certain rights under the Act. Whereas if the same 5% is held by 500 people, now this puts a challenge. Unless otherwise 50-55 of them together join, you are not crossing the threshold of 1/10 of the members, right? And let's assume this 5% is held by 5,000 people, then you need minimum 100 of them to join together to even be able to take this basic rights. So if you really look at it, the minority can vary in from a case to case based on the scenario. Let's take some interesting situations. Some of the Tata companies, the block holding by companies in that are in the range of 2%, 3%, which is significant, substantially significant. So even a 2%, 3% there could have a substantial premium for that block, because the shares are otherwise so widely disbursed. So with 2%, 3%, you will be able to exercise certain amount of control. So coming back to the key thing, to differentiate the type of minority we are talking about and the approach we should take about it. In some cases, we may have to, though it is a minority holding, like for example, let's take a very, very simplistic thing. Somebody is holding 24% or 23%, near close to having some substantial rights. We may have to go back to the business valuation model to be fair, because ultimately what is expected is the valuation has to be a fair valuation. Whereas if you are looking at a company like what I was saying, publicly listed, where the bulk of the shares are held by individuals on a very, very spread out basis, there are only hardly 3 or 4 people holding more than 2%, 3% stake. Even a 2% block could have a significant premium getting attached to it compared to a retail share. I'm only saying in comparison, because the premium or discount will always be in comparison to the other. So this is the crux. So even the minority will have to be differentiated and taken. At the other end, let's say we talk about companies like some of the companies we were talking about, where let's say 2 or 3% is held by hundreds of people. The rest of it is held by the promoters. And considering the size and nature of that company, there is no visibility of any immediate listing or anything like that being even thought of. This shareholders who are holding less than 1%, 2%, and individually probably holding in the 3rd degree percentage, that's what they will be effectively holding individually. Their valuation might be at a rock bottom, because their share may not be able, they may not be with their share, they may not be able to do much. Even to garner 100 people together to do some action would be a significantly difficult task. So if they sell, that's shares.
Balu, is that not an assumption? Balu, is that not an assumption that we intend to do something? I'm saying at the end of the day, the instrument has a value, and I could just be doing it from an investment perspective. Correct?
See,
so
the whole valuation is about future.
There are a lot of shares abroad, and I'm sure in India also, I think it started, they have various different voting rights as well, right? And because they have different voting rights, sometimes there are different value attached to this. But I'm saying the underlying instrument, the underlying business, they continue to have the same value, which means we are adding variables like ability to vote, ability to control the operation. But that is not the intent of the investor. Say, for example, if you look at lakhs of investors which are investing in the stock market, there is no intent of those investors to take over control. Otherwise, the value of all the investments in the stock market which is just less than 25%, will be at a different value. And the people who are holding more than 75% shares typically should be of a higher value from that perspective. So I'm saying, in this entire scheme of valuation, why are we trying to bring in these elements, which in life may have some value attached to it, but fundamentally that does not add to the valuation in terms of the value of that of that instrument. So I'm only trying to kind of get this clear in my mind in terms of when do you really attach a value.
Correct. So
only because I could go and maybe pass a special resolution, only because I can go and maybe file something to do with operational misconduct, only because of A, B, C, D, E, F, G, you're attaching a value, right? Which means assuming that if this discussion is right, then anybody who's holding more than 55, 65, 70% of the holding of a company should ideally be valued at a premium in the stock market. So Mr. Ambani's shares should not be $250 billion, they should be $350 billion. I'm saying theoretically. So how do you draw this, and what does really come into this picture?
Actually, there are two aspects to it. Though we talked about one of the aspects, there is a more important underlying aspect. The voting right and all is only one part of it, or one facet of the issue of what brings differential value to this whole thing. Many times it's not just the voting right, it is the ability to control and manage it the way you want. For example, if you are a promoter shareholder with 75% shareholding, you have the ability to manage the business the way you want, and maybe even rearrange the business the way you want. Correct. To enable certain cash flow. So you may consider a business valuation on that basis. To give a very, very crude example, let's assume a company has its main factory in the heart of the city for historic reasons, right? If the promoters are desirous of it, they could always shift this factory to some other location,
correct,
put this property to a different purpose, which could significantly increase the value. Now, if you are a 0.001% shareholder in that, you don't even know whether the company will do it in the next 50 years, 100 years, assuming there are no plans right now and the company is running well, and it is running from that location only, and it's also cash flow rich, so it's not even looking at unlocking that. Where is the value you're going to get for that from? You cannot wait for eternity, for probably the fourth generation in my lifetime, to see that windfall coming to them to determine my value today. If you really look at the gray market where there are transactions happening, you will also find that these shares are not getting reflected for those values. The other way of looking at it is, this is not exactly the same, but the way you find this in the listed company market also is where you have these holdco discounts. One of the Correct. Reasons why you have such a significant holdco discount is the shareholder of the holding company does not have any direct say in the subsidiaries operations. In fact, I have seen one company where it has an associate, which is also a listed company. Just the associate's shareholding, if you add up, its share value will become something like, if you don't add any other book value, anything, the listed associate share value, if you take it per share of the holding company, it would be around 5,000 rupees a share, whereas the share is trading at 1,600, which means people have not even taken cognizance of that associate's value in it. Primarily because they know that these are things which are never going to be unlocked or not in the...
Balu, you're absolutely right. And we will not stress this. I just had a winding up question on, especially around this, that you're absolutely right. Somebody has not, like, for example, you had all the mills in Mumbai city, right? And Phoenix could be one example for the sake of name, right? At a particular point in time, the value would have been absolutely zero, no value, right? And there would have been small shareholders languishing. Somebody would have even thrown out their shares. But suddenly somebody realized, the realization was always there on the paper that the value of the property is more than 50,000 crores or 100,000 crores and stuff like that, right? So the value of the share today is, say, 50,000 rupees per share, right? Which was almost zero. So I'm saying the underlying value of the share does not change. It is ability to perceive and maybe ability to sell at that point in time changes, is what I've say. For example, a Tata Group could be a good example. Mr. Mistry trying to, fight for his valuation, right? Now, if you ask me, fundamentally, the value of the Tata Group would be X. And if you divide it by Y, the shares would be of that value. So sometimes because of the power of the minority shareholder, you could get more money. Or sometimes because the power is not there, you could end up getting less money. So I'm saying why should it impact the fundamental valuation of the instrument? Are these considerations not outside the valuation purview?
See, the whole thing is valuation is always linked to a purpose of valuation. Let me give you a simple example, not directly connected, but just to bring out the point. If you do an analysis of the ESOPs given by companies which have then in
Fantastic
the next
example.
1 year, say, gone for IPO, you will generally find the ESOP valuation was 50% of the IPO price. Does it mean that fundamentally there was a difference? There is a significant difference in the purpose for which the valuation is being done. A strategic, that is what is also there in our different braces and premises which are also talked about in our valuation standard. So this is something which can always be there. And second thing, I don't think that the value already exists always. Value is always as a point of time. The value is not that it is existing, but it is not getting unlocked or something like that. Always.
Fantastic.
It could be completely in future, because simply take an example. The best example probably is the company which had the gas line rights in Bombay, South Bombay. It's a very interesting case. There was a company which was having rights to run gas pipelines in Bombay, because historically, long back in the South Bombay, there were pipe gas supplies. That company went defunct. So anybody who had traded in that share would have been happy to get even a par value for that, right? But suddenly, when this new this thing came for internet, for running the cables for internet, also later for pipe gas, again there was sudden renewed interest. That company got significantly valued. Now, the value came not because the value was always existing. The value came because of a new business model which came, right? Which couldn't have been even thought of probably at that time. So there are the value is that way very, very clearly linked to a point of time.
So I think one learning that I have taken, and maybe that's what you're trying to impress upon all our members, is that purpose of value is very, very important at any point in time. Of course, point of time is a very important fundamental rule in valuation, but the purpose of value is also very, very important. So I think that's a good learning. And some good examples that you gave, Balu. Yeah, back to you, MP. Fantastic.
Yeah. So again, sorry, I'll just wind it up. On the purpose, I'll just now bring it in line with the minority and also explain. Please. Let's take two different scenarios where a company promoters are already owning 75% and they are trying to acquire off another 10% of minority stake, versus somebody who's already owning 95% trying to acquire the balance 5%. Whether they acquire the 5% or not, they are completely in control. They have nothing to bother about, right? Whereas in the case of 75 and 25, which is out, that 10% is going to make a significant difference to them. So even there, even at a given point of time, there could be difference in minority itself for the acquisition. Yeah, sorry.
I think very interesting discussion, Anil. Thanks for triggering that. It was a learning, as you mentioned, but I just want to give my thought on that, Anil. As far as what we see in the market, stock price, it is actually a price and not a value. It is price for the trades which are happening and for those volumes. And it has nothing to do with the value. So it's the same entity. If somebody wants to acquire a 10% or a 26% or even Mukesh stake itself, obviously would pay something far different from what it is being traded. So fundamentally that difference is there. Second, also on minority, one word of caution for all the people who are listening and my own little experience. Minority valuations are extremely complex and they can never be formula based. You have to actually study so many related factors in terms of the quantum, potential buyer, and the rights which are coming, etc. I'll give a very simple example. Of course, Balu did mention a few cases. Let's assume an unlisted company with 3 shareholders, like 72%, 23%, and 5%. Now, this 5% holder, his per share value will be much more than somebody even having a 73 or even 23 for that matter. Because this 5% for 72% guy is a different value. For a 23% guy is a different value. So each of them, so there's so many underlying factors. So minority valuation can never be like some other valuer has done, I'll copy paste that formula and do. No, because you have to go through so many other aspects relating to that particular entity's other shareholding aspects before somebody can come. So going to the next question, Balu, what are the differences which needs to be considered between valuation of a majority holding and a minority holding?
Okay, so like we were discussing earlier also, the various things which needs to be considered are, one is the whether for the purpose of the thing, whether we can do a business level valuation. In the case of majority holding, it's largely business valuation, which will be the crux of the valuation exercise. So we need to see whether we need to approach from that same approach for a minority, a business valuation and a share of it being the minority share, or should we completely approach from a different direction of what is the financial instrument worth as a financial instrument without going into the business valuation. So the various things we need to do is, one is the percentage of minority shares which are being talked about, the type of transaction, like I was telling you, whether it is a 236 or a selective capital reduction kind of a thing where it's a forced exit, vis-a-vis, let's say, a buyback scheme where it is an optional scheme which is being given. So that can also be another factor which can have an implication on the kind of approach and this thing we're going to take. The number of shareholders who are adding up to that minority holding which is there. So that could also be another factor, like you were mentioning. If it is just a few people, then obviously the valuations could have an implication because of that. So that is the third thing which is to be looked at. And fourth is whether, I mean, without going into the regulatory requirements, I'm talking about whether it is a listed company or a company which is quite likely to be listed in the immediate future, vis-a-vis a company which does not seem to have any thought process or indications of getting listed in the near future. Like there are quite a few business houses which are having very large companies which would put to shame many of the listed companies in terms of their size and business levels, but they have not been looking at listing for the last 50 years, and I don't think there is any visibility of that happening in the next couple of decades at least. Not even to raise funds. They are sitting with surplus funds. They won't even raise funds. So there is a significant amount of difference which can come on that count also. So that is the other aspect which can have an implication on this thing. Other than the normal things which we would anyway consider, these are specific aspects which we need to consider. I would emphasize significantly on the shareholding pattern and the distribution in that as one key thing. The potential for changes happening in terms of its listing, etc., as another key area. Third is potential of, or at least known or reasonably expected change in business use of assets. Like, in the case we were talking about itself, where already there are news reports about the company thinking of shifting its plant from the city to somewhere else, etc. And if that time you are going to be, let's say, making a fair valuation for buying out the minority shares, if you don't consider that, it may be inappropriate. So we need to also factor those into consideration. What is the likely or reasonably likely change which can happen in the which is somewhere in the annual, at least at a preliminary discussion level or things like that. So that also has to be surely considered and brought out into this thing also. In fact, some of the case laws, the disputes have been around these areas only, because that can significantly have value implications.
No wonder so much of disputes on minority valuations. So it's so goddamn complex. So,
absolutely. In fact, I expect quite a lot of litigation to happen before it even settles down. For example, under 236, we have not had any litigation till now. So these are things which are going to come.
One point, Balu, on squeeze out provisions, even the couple of cases which have been settled, they have come in such a way that no company wants to attempt squeezing out, because the court judgments are so much in favor of that small shareholding that no company wants to go through the process of attempting a squeeze out. So let's be aware of that as well. So it's so tough. But just taking this discussion forward, Balu, what are the various inflection points in this continuum which we are discussing, from a negligible stake to a 100% stake? What are those various inflection points which are normally there?
Yeah. From, again, Companies Act perspective, we all know that there are significant rights which can get attached at certain levels. So, for example, surely that is one factor we need to consider in our valuation approach. One is where it is a very, very negligible shareholding, or you have, let's say, amongst yourself or together as a minority group, more than 10%, which means 10% of the shareholding or 10% of the shareholders who can come together easily, which means you have certain rights. So obviously you can be at least a nuisance value. So there is a there is a need to consider that factor also into the next step, because if it was below that, let's say the whole percentage of holding and my number of shareholders also is below 2%, the shareholders cannot do anything in the normal course. Even to approach NCLT, they will have to take special permission, which very rarely would be considered. So literally, whether I buy it out or not, it makes little difference. So I can just let them languish there with their shares with no value or no return to it. And as a majority shareholder, I can sit pretty. So 10% is one inflection point where there is a significant change which happens. Similarly, around 26%, where you can have certain other controls which can come to you. And then when you cross 1/3 and when you are close to 50%. So these are, I would say, in the normal course, the points of inflection where there could be a change happening. But this is in the normal course. However, it also depends on the way the shareholding is structured in the company. For instance, if there are 5 people holding 20% each, now even to buy out that 120% from 1% makes a significant difference to somebody. So the shareholding structure in each company could also differentiate. And like I was giving an example where, it is so widely held in the market, a 2%, 3% could itself become a block sale with a premium being attached to it.
Balu, we discussed a little bit earlier, but just for having completeness, from your experience, what are the likely areas of controversies or disputes which arise in minority valuations, especially in Indian scenario? You mentioned about prime properties, major expansion plans, some strategic partnerships, global expansions. So these are things where insights are relatively less available, and less influenceable in terms of decision making as to future value creation or value destruction. So those things, how are they? What is the experience in value considering those for valuation?
Yeah. So the various things which could have an implication on this, first and foremost, is the see. Typically, we all know surplus lands, if they are there already, then that is separately anyway considered in valuation. So that is one side of it. But it becomes murkier when it is presently, like for example, the case I was talking about, where presently a prime property is where the factory is located, or forget even the factory. Factory is difficult to shift, or let's say the headquarters is located and it's operating out of that, right? And that is considered as a business property and not as a real estate. Whereas there is all the feasibility to say shift it out to some other location, in which case the valuation could be much higher. So this is one sure area of controversy which happens, especially in the Indian context, where reality prices have zoomed really, all right, over a period. And there are quite a few companies, because the way cities have expanded, etc. Suddenly, what was empty land and nothing much to value at has become prime properties. I don't know. Anil, are you from Bombay? Because that one interesting story I've heard is about there is a complex called Thakur complex in outskirts of Bombay, Kandivali.
The name?
Not really outskirts nowadays. It's part of Bombay.
No, it's a suburb. Yeah.
What is the name? What is the name of the complex?
Thakur.
Thakur complex. Yeah. Absolutely.
I believe the history is that it was a cowshed area, but it was a dairy farm. Thakur was having a dairy farm there.
Absolutely.
And he sold quite a bit of that land, and he became a multimillionaire. And he has a set of houses which are the only individual houses in that whole complex. Everything else is a flat. Okay.
Correct.
He has individual houses which he is still owning. He has become multimillionaire just by sitting on that land, which was used for raising cows.
Absolutely.
When he grazed cows, he would have never thought this is what is going to happen to him. So things can change significantly in terms of value from that. And there have been disputes on this, surely. One big area of this thing. Second area is where there are some major expansions, or where there are some new product introductions, etc., which are being contemplated. How exactly should the value be taken cognizance of in your valuation when you are trying to do it? Most of the time,
but Balu, while you're absolutely right, I'm saying and I'm speaking this more from a valuation report perspective now, and not from a price perspective, right? So if somebody calls me to do a valuation of, and I'll go back to my old example of Phoenix Mills. I don't know if you've heard of that in Bombay. It's become a big mall and a entertainment center today. If you would have asked me to value that maybe say 10 years back, as a fair value, I would have definitely considered the price of the property at that point in time, right? And I would have simply taken the price of the property in Mumbai city rather than forget about thinking through entertainment center and all of that, right? So we'll not even get there, because maybe the business model would have evolved, not evolved, somebody would have made a loss. All of that is a different story. So if I would have added that fair value, the value of that equity share would have still been, say, 10,000 rupees a share and not zero, for example, right?
Yeah.
But the price that somebody is willing to pay for me, pay for that share today, because there was no liquidity in the market, or the promoter does not have the money, the price is close to zero, for example. Now, how does one do a valuation report in that perspective? The value is 10,000 for every share in that organization. But because I hold maybe 100 shares, or all the minorities put together, how do you value that equity share?
See,
it will only come back to the fact that, are you able to sell it? If you're not able to sell it, then your value actually comes to zero. But I think I liked what MPV said. The value is not zero, the price is zero for whatever reason, but the value still continues to be 10,000, right? So What do I do as a valuer, a registered valuer?
So, for example, at that time, the approach would ideally be, because at that time the known thing is the value of the land, right? Known thing is the value of the land. Obviously, if the known thing of value of land plus a business model on it is worked out, it will become significantly higher. But that is something which is an if, which is in future somebody has to invest money for it, somebody has to do things for it, etc.
Correct.
So the value of the land as of today at this thing, because it is available as a land, it is not being put to some lower use, right? You could take it as this thing, provided it is empty. Now, if the mill was running and it is the mill which you are valuing, then obviously this land does not have the same value which it could fetch if I can just sell it as land, because the mill can only give you certain return. So your valuation will be based on the return which the mill can make. So this
Correct.
exactly is the crux of the dispute when it comes to such use of premium properties. This is exactly the dispute which comes. Do I value it as a running mill at mill's return, or do I value the land and take that as the basis, adjusted for whatever
So
else?
I'll just hold you for a minute. So this is a fantastic example that you gave. Do I value the mill which is running, partly closed, loans being outstanding to banks? And if you were to call me as a valuer, a registered valuer, should I take that? Or should I take the value of the land, which is in multiples of 100, for example, right? Conservatism would tell us that we would ideally have to value it based on the fair value of what is the value of the equity share, right? So I would probably go and value the value of the land and then come back and say that the value of the equity shares is 10,000 bucks, correct? So now, how would one hold this valuer in sense that is this the right valuation, wrong valuation? Because if I go and value my equity shares based on the partly running company, I would come back and say that value is only 10 bucks, right? But tomorrow, for example, if I sell my shares for 10 bucks and now the promoter has all the shares and he suddenly says that, okay, the value of the land is 50,000, so it's 10,000 rupees an equity share. Then are you held responsible? How do you work on these matters?
So here the crux of it is, like you were saying, that to take the decision whether I should value the land or the running mill will depend on 2-3 factors. What is the purpose for which the valuation is being done?
Okay.
So you can as a valuer you can also bring out that aspect by bringing in the right base and the right premise which you are going to be using for that purpose. To just give you an example, so we are talking about basis. The basis could be, right? The basis could be that you're going to use a premise of fair value, or you're going to use a going concern value, specific person's participants value. Now, these are things which you can use to bring out what you're going to use. For instance, if there is all the support which is available to show that for the next couple of decades at least, there is no chance of this mill being converted into something else, the mill will run as a mill, I would say that I am going on a going concern basis and I will go and value it at a mill. But I would, as a valuer, emphasize on that choice of base and premise appropriately to bring out that fact very clearly in the report. Now, very interesting thing, we will also see that later on this. But coming back to the disputes, this is one area of dispute. And as of today, in the past, most of the cases which have been taken, as MPV was also mentioning, the courts have been more favorable towards minority shareholders. However, let me also tell you, this is not an India-specific phenomena. It is a global phenomena. In fact, somebody did an analysis, and I think I also presented one case in one of the this thing, that when companies do a buyback in the US, the buybacks are timed in such a manner that they do it in one of their worst years in terms of performance. So they pay less to buy out. So these are strategic, as I said, values as for time always. So you cannot, but the difference between a squeeze out and buyback is something we should always be also keeping in mind. In the buyback, you are not forced to sell. It's an option. So you can continue to remain as a shareholder for whatever it is worth. Whereas in a squeeze out, you are being given no choice but to go out. So that also we need to balance out.
Actually, Anil, just to add one point, Anil, it's a it's more a governance related question, where company changes its intent after the transaction is completed. So to plug this, for example, in the squeeze out provisions, there's a specific responsibility cast on all the board of directors that the valuation report which has been given has to be certified by the directors. So, which means the underlying assumptions, directors cannot change it within few months. They can change it maybe after some time. So I think there are some inherent governance provisions like that which are there to prevent such misuse. Similarly, with reference to even buyback, as Balu mentioned, it's only optional, but there are restrictions in terms of entering into further issuance of shares or further capital transactions up to 6 months, 12 months. There's some norms like that which are
okay.
And my view, market will punish such organizations or entrepreneurs if they indulge in this kind of a governance. It can at best be one short-sighted measure.
No, I understand MPV. I was not even getting there. I'm only trying to fundamentally again set the same foundation, right? That the value continues to be the value. Yeah. It is the price which is different, which means you may want to apply certain discounts on it to say that because of the time sensitivity, because of the purpose, because of whatever, now you may not get 10,000 rupees per share. You may end up getting maybe 50 rupees per share, for example. But the value is 10,000. The value is not less than 10,000 is what I was. So I'm saying for our members to be able to carve out a right valuation report, it's very important to understand and put the right value, because who will be called to question tomorrow? They are the ones to be called for question tomorrow, right? The first line of defense is the registered valuer. Then it will go to the board of directors, and then it will go to the company, which all of us know how it really works in the practical world, right? So you always catch the lowest possible person in the rank, and which sometimes happen to be some professionals as well. So anyway, I get the point, which is interesting. I'm saying in a way that we need to articulate to people is that the value is X, but you may want to apply different sets of principle and then come to maybe, I don't know whether you want to call it a value or today's value or price, but that is how it is arrived at. Fantastic. So yeah, back to you, MP. Thank you.
In fact, this Thakur complex, for those in the South will know that the situation is almost like super hit movie of Rajnikant, which actually defined his career big, a movie called Annamalai. So there also he has a cattle shed, which is a fairly large parcel of land adjacent to another hotel, and from there his riches come.
No, so there are several stories here. All the mill compounds that you had in Lower Parel, MPV, and I'm sure you've seen all of them. Have suddenly been from rags to riches story. And it has actually helped the promoter to drag the cases in the courts or in the banks for several years today. And they're suddenly, sitting on a property which is a fantastic value. But anyway, I mean, such is luck sometimes, but good.
So Balu, going forward, can you throw some insights on the Cadbury case in the context of minority valuations?
Yeah, that is a very interesting one. MPV. Actually, this is one of the topics which I was also talking about in terms of the various differences, etc., which could raise dispute. And Cadbury is a classic example of that. So what happened was that the background is like this. Cadbury was coming out with the buyback and reduction scheme, a scheme through which they were to do a selective buyback and reduction, right? Mainly to buy out the minority shareholders, because I think 98% or so ASPAS was held by Cadbury globally, and the 2% or so only was left behind with Indian shareholders at that time, minority shareholders. So They had originally gone to two reputed CA firms. In those days, it was only CA firms, no registered valuers were involved. So, but they've gone to two reputed valuers and they have taken a valuation. And on that basis, they had offered 1,340. Now, this is in the backdrop. We need to also understand this is in the backdrop that already earlier there have been other buyback schemes. For 4 or 5 years, they have offered different buyback schemes, starting from 750 rupees to now reaching to 1,340 in this year, right? So this was the backdrop in which this was happening, and this was disputed. So some of the minority shareholders went to the Bombay High Court and raised a dispute on the valuation, saying that the valuation was unfairly done, etc. Then the court appointed a third valuer, right, to look at it. And the third valuer came up with another valuation report based on his own this thing. He had used simply a comparable company method to arrive at this first valuation. He arrived at using a comparable companies method, and he arrived at 1,700 odd rupees as the value for this. So from 1340 now it has become 1,700 odd, right? By the time the third valuer report came, that again was further disputed. And one of the key contentions in that dispute, which we will see in all the list of major disputes raised by them, was that Cadbury had a prime property that was considered as part of the business asset and no separate valuation was taken for it. Whereas the minority shareholders were saying that that prime property will have to be valued separately and added, because that was essentially their small office, I think, and largely residential.
No, I think they have a property at Pedder Road. If I'm not sure about the case, but
Road.
I think they have a beautiful property there, and I'm
opposite
sure it must
that
be
Mahalakshmi corner, no, where you turn.
Yeah, it's a beautiful property. Yeah.
So that property, they wanted it to be valued separately. That is primarily, I don't know what it is now. That primarily was the residential property of all their key people.
Correct.
So they wanted that valued and added separately, right? So this was the crux of the dispute, or rather one of the key issues which arose. There were other things like saying that they have not used DCF method, etc. So the court also said, okay, third valuer, you please go back and redo this thing by DCF also and come back. So they came back and finally they gave an average price of 2,000 odd rupees, which the court cleared. But the key things to point out here is, this is the only case where the court has gone on to say, okay, you try this method also and work out and bring it. And finally also have come to a conclusion where they should take it based on this. And in the discounted cash flow method, they had come up with, I think, roughly around 2,400, 2,500, because the average was around 2,000 rupees finally. So this is what happened there. Now, what are the key things they had contended and disputed on this? The first one was terminal growth rate. Now, imagine in those days, actually, they had taken a terminal growth rate of 6%, right? 6% was disputed, saying our annual growth rate for Cadbury at that time was around 20%, 40% per annum. So where is 6%? This the court threw out. Right? Fortunately, it is very difficult for a non-valuer to understand terminal value growth rate of 6% vis-a-vis the current growth rates of 20%. But the court threw out that they did not consider that. The second was that the tax rates which were taken, they had taken the applicable tax rate, whereas because of various benefits they were getting, the effective tax rate was far lower. As against 35% roughly, it was only around 20% their effective tax rate. of course, we need to also see all this. These were the contentions raised, and which is why they were asked to redo, etc. Right? Then they had also questioned this property, which was the big part of the dispute actually, because that property was worth thousands of crores. That is where the key difference was also lying. After the DCF report was given by EY, court said nothing more, nothing less. There has been different experts who have worked on this, and we do not have the expertise, nor do the minority shareholders have expertise to look at all this. And they have done their own diligence in arriving at this valuation, and having done diligence on the DCF, which they have accepted and taken forward. Nothing more. Here, the buck stops. Now, the key thing which is to be considered is, even today, that property is still being used for the same purpose. There has been no change in purpose. But it leaves a gray area. Two things I wanted to point out. There could be future disputes in minority share valuation where there could be a much more stronger fight by the management on such properties which are currently being put to business use. But at the same time, I also want to park this thought. This particular building we were talking about is not a factory building. It is not that, it is impossible to shift a factory, etc. It was residential buildings where all their senior ranking personnel were staying. Their directors and their KMPs were staying there. So it's purely a residential building. Now, whether that would make a difference, quite likely that could make a difference, because that can easily be put to different use in a business scenario. So these are things which needs to be probably considered and factored in doing it. Like the example I can think of is, when we look at some proprietary business valuations, we always make adjustments for proprietor, whether he has drawn his salary or whether he has taken something which is excessive, which should not normally be applicable in the market. Same thing here, you have provided them accommodation in 1,000 crore worth property, whereas you can provide them similar accommodation with probably a couple of crores being the charge to the P&L every year for rental. So how do you want to do it can be an area of dispute in future. I do not see settled cases completely coming to minority matters. So I expect there could be more such cases coming up, provided there is significant values involved in it.
Actually, where people are looking at taking private and all, these are pretty likely to be there. In fact, I'm a firm believer that as the country goes to a developed economy state, hopefully in the next 10 years, litigations will only increase. So as long as people know the other person has the potential to pay, litigations will keep increasing. So I think all the more important that valuers should be more cautious. So just taking the discussion one step forward, Balu, we have this lot of companies who are listed in regional stock exchanges, and they're still there in whatever form and shape. And many of them are looking at going private, buying back those shares, getting the shares delisted and things like that. So what is the experience in terms of valuing those situations?
Okay, so with the regional stock exchanges going out, actually the Indian history has been that many of them, there is a statutory requirement to offer an exit option for the parties who are holding shares, but that's an optional exit option, right? So the shareholders, minority shareholders, have an option to sell under that exit scheme, or they could continue as a shareholder. So it's more like the buyback. There is an option for the minority shareholders. So that is something we need to bear in mind. However, what has been noticed is that these valuations are done by merchant bankers because that is how it is mandated or it was mandated in the SEBI directions at that time. Of course, if the directions were to come now, probably, because SEBI has switched to the use of RV, they could probably come up with something else. But when these large amount of delisting happened, the guidelines were based on merchant bankers' advice to be taken on the value to be offered. The exit offers were significantly subdued. The minority shareholders, especially if you take companies like many of the plantation companies, if you apply even the revenue evaluation, the revenue evaluation would have been more than the value offered because the land value would be significantly large, but the companies were not valued well. So this is one serious area of concern which was there. But frankly, this also puts the difference between the minority shareholders' viewpoint of one outlook and the company's outlook. If you take example of all these plantation companies which went through this delisting, you would find that from their side, though the land is supposedly valuable, much more higher, significantly valuable, the actual returns they were making were insignificant, and they had very little option to put the land for any other use. Even as land, though it had a guideline value which was significantly higher, there were no buyers for those estates because they can continue only as a plantation estate. So frankly, it is a dilemma. On one side, you have guideline values which are significantly higher, but practically in the market, you may not find that kind of prices. So what the merchant bankers have done, which is also very important to note that, the the merchant banking, the SEBI guidelines also largely talk about use of variables like return on net worth, book value of shares, EPS, price earning multiple vis-a-vis industry average, and other factors that are customary in valuation. So let's leave the other factors which are customary in valuation aside for a moment. They basically, the SEBI regulations everywhere broadly emphasizes on use of EPS, book value, net worth, price earning multiple, and industry averages. This is what it is largely is talking about. It does not talk about a DCF per se, right? Very clearly bringing out the this thing that minority valuations, you try and look at it from a instrument perspective, compare it to that. What would be what would be the value which you would derive based on the prices which are there for comparable companies in the market at that time? So you use some comparable companies multiple, you are better off in these things is what looks like. I mean, though it is not very clearly there, it looks like that, and that's how the values have also been provided in most of these delisting. So if you really look at in the Indian scenario of minority buyouts, there have been cases like Cadbury, etc., which are more driven by the Companies Act, right? Schemes where the courts have been more pro minority shareholder in most of the decisions. Of course, they are very clearly held in many cases that valuation is an expert area, and if there is an expert who has been involved, unless we have reason to believe that there is something basically wrong in what has been taken, we will not intervene in that. However, wherever they have intervened, it has been more in favor of minority shareholders. Compare that with the whole loss, a lot of exit offers which were given under the delisting under from the regional stock exchanges, where largely the prices have been more based on non-DCF based methods probably.
I think MPV, I'm sorry to interject, Balu, but I think there's a very interesting case here, because what I understand from Balu is that, variables are many here, right? And is that not an interesting case to kind of define some standards around this? And this is again a loud thought, okay? Like, for example, a property which is valued at an X price, and believe me, the minority shareholders would have a say in that, because they know that, for example, the valuation of the company is, say, 100, and the property itself is valued at 40, for example. So you've given me a DCF valuation of 100. Then there are executives staying in that property, which means that property has nothing to do with the outcome of the DCF valuation, fundamentally, right? I should technically add that 40 bucks, because that is an asset which is not producing. So in a prudence, if the management was running it appropriately, they would actually rent out a place for their senior executives and sell that property or develop that property, right? It's just because you don't want it to be valued. So I'm saying, is there a case for us in the institute or anywhere to be able to have some method in this madness to say that, look, if you're doing a DCF valuation, then in order to consider other valuations, say, for example, I'm saying, let's forget about 40. The property would have been valued at 200 bucks tomorrow, right? DCF, going concern, Cadbury, great brand. You have to value it at a going concern. There can be no valuer which will come and not value it at a going concern, right? So I'll always give it a value of 100 based on whatever has been given to me. But the property is valued at 200. What do you do?
I agree, Anil. In fact, there are many business houses both in West and in South which have been in existence for 50, 60 years, and they're now in the third generation or so. And those days they've got those freehold lands, which those days probably are outskirts, and today they're within the city, and huge valuation. And there are third generation, fourth generation, some of them putting it to good use, some of them frittering it away and shareholders losing. I think there's a point you're mentioning. I think we'll certainly deliberate, Anil. I think at the minimum, we should develop a guidance note on valuation for minority shareholding, because there's so many variables. I'm not sure about a standard, but in the standard, we have principles laid down on how to adjust this. So taking those principles, I think there's a good case for developing. I'm actually getting more convinced. In fact, the subject is looking so complex that, and I know it's litigative. It's highly litigative. The more the value, it's going to be more litigative. And with class action suits permitted under the new Companies Act and all, and lawyers can always fight for these cases and get a percentage of fees also. So unlike chartered accountants where we have this restriction, so they have those benefits as well. So point taken, and like I think we should. So
it's like literally is your logic against my logic,
Correct.
So I think there are some interesting questions. You may want to do a rapid fire. This is really getting interesting.
In fact, just for the benefit of Balu and others, we have more than or approximately around 6,000 members attending. And already about 80 questions have come in, and I'll keep picking up a few questions from there. So Balu, on this comparable companies method and comparable transactions method. So what is the experience around using those methods for valuation, and how do we apply the discount for lack of marketability, or the jargon of DLOM, which is there?
Okay, so so in the case of minority shareholding valuation, right? If you look at comparable companies method, essentially it is driven by the prices which have been actually reflected in the market by transactions which are happening in the market, right? And by and large, if you see, these are transactions which are happening at retail level. So it is an ideal comparison for minority shareholding valuation to use. If you can ideally get right comparables from the market, that would be probably one of the best methods to use for minority shareholding valuation, because it exactly reflects the kind of market approach to the minority shareholding. However, you may need to adjust it for lack of marketability, because this could be an unlisted private company, whereas the data you are getting from is from a listed company where there is ease of marketability there. Now, when we are applying the lack of marketability discount, we also need to factor one more thing as a valuer. There are informal markets for some of these unlisted companies where there are large number of shareholders. Now, the presence of that also can be considered to probably have a differential lack of marketability discount as opposed to a company where there is absolutely none. So this is also something which can be probably considered appropriately by valuers when there is some off-market options which are available practically. Practically, it is there. I mean, we need to be very pragmatic about what we are doing. We cannot just shut our eyes to the idea that there is a market for it. Maybe a little less, but yes, there is a market.
Balu, there are lots of questions and I would like to cover as many as possible. Probably from here on, we can attempt very short answers or one word or one line answers.
Good, we'll do that.
Yeah, exactly. We'll attempt because people with so much of interest have sent very good questions, except the taxation related questions. I'll attempt to ask most of them. When we do a valuation report under section 62(1)(c) of the Companies Act for issue of capital, say additional 10% by a private limited company, should the valuation be done on controlling basis or should discount be considered?
See, when you are issuing shares, you are raising capital for the company. So you are basically pricing the share for raising capital, right? So as a company, you would like to get the best possible price in. So I would say that this should be based on the business valuation which is done, and then arriving at a value based on that, considering the business plans which are already in the table.
Correct. Second is there any valuation for minority holders in Nidhi companies incorporated under section 406 of Companies Act?
I would park that because I have never dealt with a Nidhi company. Okay. So unfair for me to.
No, appreciate. Sincerely appreciate. There's an interesting question, but I think we have discussed which method can be used to nearly satisfy minority shareholder for valuation. So the answer is in the question itself. So nearly satisfy.
I would say the best methods to use would be always CCM when it comes to minority shareholder in the normal course, under the Companies Act, etc., which we are doing. But after doing that, you need to necessarily consider, like we were discussing, properties and things like that, exceptional matters which will have to be factored if at all. That needs to be considered. Otherwise, as a method, CCM would be a safer and better method to go with.
Okay. Can two valuation reports be taken at same time for two sets of shareholders? I think what he's meaning is for somebody who wants to sell and somebody wants to buy, maybe.
Theoretically, yes. For example, if I'm having somebody who's getting a majority stake and somebody who's where I'm buying out all the minority stake, I could theoretically have a control premium, which is there. However, this is subject to regulatory issues, which could be there in certain cases. But theoretically, yes.
There's an interesting question. Any guidance on how to value premium for minority shareholders? How to convert the control benefits into value?
See, there is no hard and fast rule for this. Ideally, the way I would go about is, see, one thing, in fact, I would like to say is that probably the institute can look at more research data being made available on valuation subject. Like if you go to US, there is enormous amount of research which is being done, including, there is a research report on valuation of florists. There is a research report available. So one thing is, if we can do something on research, it would be great. The way I would look at it is that I would try and take comparable companies considering all these factors, what you were mentioning, the kind of shareholding and percentages which are there, to make myself closer to that.
Great, Balu. One line as Balu. Is there any
Yeah.
model like optimistic valuation and pessimistic valuation?
I don't think so.
Okay.
I think as a registered valuer, you should always do an optimistic value.
Fair valuation. I would say fair valuation.
Depending on the purpose, right? So if you're working for the minority, make sure that the value is more. And if you're working for the majority, make sure the valuation is less, because you might be called by the court to do that. Yeah, that's on the lighter side.
So we can give some
Fair
work
valuation.
for our other professional colleagues in the law profession.
Yeah.
But I don't know about optimistic and pessimistic, but I think one good thing about the ICAI valuation standards versus the IVSC standards is we allow giving a range of values, but I don't think the top and bottom of the range can be called optimistic and pessimistic. But I think that little bit of freedom is there if it helps the person who asked the query. Why valuation done for ESOP cannot be used for IPO purpose as well?
Purpose is different. Very simple.
Okay. In recent mergers of nationalized banks, where is protection of minority shareholders' interest?
See, in mergers, what happens is, anyway, you are getting something in return. The challenge is, this is exactly what happened in many of the cases earlier. In fact, most of the cases which have happened in the Indian courts were to do with minority shareholders being affected during a merger amalgamation rather than, in a squeeze out or a buyout and things like that. It is more on this. There has been cases, and the courts have time and again held that the once valuer who's an expert is there and doing the job, there ends the matter. We won't intervene.
What is role of liquidity in minority valuation?
Liquidity surely needs to be adjusted. Lack of marketability, we may have to adjust if it is there.
Government of India has remarked that sale of public sector companies will be done through process of enterprise valuation. In such situation, what is the role and rights of minority shareholders and their share valuation?
That will depend on how they are going to be compensated. Why they are looking at enterprise value is because the debts which are there in those companies can be then structured or dealt with differently, because some of them might be very heavily debt ridden today. So that is why they are going on that, like Air India. So that is why they are going on an enterprise value.
When minority shareholders hold CCPS, I guess it means cumulative convertible preference shares or compulsory convertible preference shares without voting rights. How do they ensure their value when promoter decides to acquire their shares?
Very, very complex question to give an answer. It has to be based on a case-to-case analysis of the individual rights and the position of the company, etc., liquidity of the company, everything.
Okay. Valuation of unlisted companies, can it be less than book value?
Theoretically, yes, but then it raises the question: what did the auditor do about impairment? What did the company do about impairment? So theoretically, yes.
Valuation. This is an interesting one. Holding of 0 to 11%. How much premium should we add? Say 22%. How much premium should we add? What are the authentic basis or some database or something for computation of such percentage of premium, which should be acceptable in a court of law?
Yeah. So these are the areas where I think, there could be good research which can be done. We have a huge 50-year history of market transactions. So we could have some research done in the institute. That would be the best way of doing it. Currently, are there any straight databases? No, I don't think so.
Okay. Can we have a quick insight on factors affecting discount for lack of control to be considered in equity valuation?
Okay, that lack of control is very important from this perspective. So very quickly, if you look at, for example, you're taking the comparable companies method, you can't adjust for DLOC on that, because the comparable companies multiples are all based on retail transactions which are happening. It's not based on this thing. Whereas if you're using comparable transactions method, largely these transactions which get reported are large volume bulk transactions. So there could be a DLOC which may have to be applied if you're going to take that for comparison.
Okay.
Largely similarly, DCF method also ends up with a control interest only. So DLOC may have to be applied.
A little out of syllabus kind of thing, but many members are asking a little clarity on difference between price and value.
I think a very important question. Yeah, price and value.
Many people are asking.
I'll simply give an example. There is a company, like I was talking about this. There is a company which owns 20% of another listed company, and that listed company's share price into the number of shares they carry. If you compute that and divide by the number of shares which are there in this company, the average price comes to, our average value comes to 5,000 rupees. Whereas this company's listed share is trading at 1,600 rupees. This is price and value.
Oh, that's nice.
Every holding company, you will find this kind of a difference between this. And this is a classic example of price and value.
Okay. Will the value differ if the buyer of minority is the majority holder or an outsider?
Surely it will differ, because it again depends on the purpose. If the majority holder is trying to cross from 75 to say plus 90, he will pay a premium. Whereas if I'm holding 100 shares and somebody else is going to buy that 100 shares, which is both negligible, we both might only be, the buyer might be only looking at a low price.
Yeah, actually, there are at least 20 plus questions on the valuation of land which is not put to business use, but I think we have had a good discussion, so yeah. I'm not repeating them. Now, can we use HABU method, that is highest and best use method, for valuation of non-financial assets?
Actually, this is one point. In fact, I should have raised this earlier. The key difference, as I see it, between 301 and 303 is HABU. In 303, as I'm only valuing financial instruments, I cannot consider the HABU of the assets in that other company in the normal course. I do not consider, because I don't have control over it, right? Whereas in 301, HABU is one of the key principles which is there for fair value computation, except if you are going to go for liquidation value or things like that, right? HABU is something which is built in 301 very, very clearly, and HABU is applied only to non-financial assets. So the moment I say I am going to value it only as a financial instrument, the financial instrument becomes a financial asset. HABU does not apply, and our standard also does not talk about HABU anywhere in that context. Yeah. And not only our standard, internationally also, I would say that the same principle applies. Primarily, the crux is there is not even a small control for me over it.
Yeah.
But sorry.
One point on that, Balu, even in 301, just because we have a large audience and it's an institute platform, I just want to ensure we are technically correct. 303, I fully agree. On 301 also, the highest and best use when you do a valuation of the business and a DCF, etc. The DCF actually may not be based on the best use of that particular asset. May not be based on the best use of the assets. Basically on the use which you are actually putting into for generating those cash flows. So I think lots of professional judgment is required before somebody can borrow a HABU for plugging in for an enterprise value. So this is again an interesting question. Does the valuer discover the price or does he only arrive at a value?
Only arrives at the value.
No, valuer arrives at a value, then they discover the price.
Should force squeeze out? This is also a good question. Should force squeeze out be at a premium vis-a-vis a normal vacation or buyback price, and will courts accept this?
From a pure valuation perspective, yes. there needs to be a premium attached to it because he's not having an option to keep it. See, we know options have a value, right? So theoretically, from a valuation perspective, yes, there will be a difference. Now, these are the areas where there are going to be probably future court decisions. So we'll wait to see if it goes to court that time. But yes, there can be a difference between these two.
This is two interesting questions. In maybe the last couple of questions, Anil, with your permission, I'll cross a couple of minutes. In case litigation on valuation and registered valuer has to defend, who will bear the cost of litigation if valuer is questioned in future? While accepting assignment, obviously we are not covering cost of litigation and professional fees. What is the general practice?
No, there are two things. I would correct first one thing, that the moment you as a professional is giving a professional opinion or report, etc., then you become liable for whatever comes along with it. Now, even as an auditor, if tomorrow there is a case or a DC case, etc., it is your responsibility to fight it. At the same time, in a transaction, when you are going as a valuer and advising, it is a good practice to ensure that you put these upfront as part of your terms of engagement, saying that if there is any litigation between the parties and if you have to also be present, those will be compensated separately, because ultimately you are doing it for a client, right? So that's a good way of protecting yourself. Okay. But principally, the responsibility and liability lies on the professional who has taken it.
Last question, Balu. What is the reason for Philips to withdraw the reduction scheme for minority?
I'm not getting into that. I think it's best not discussed now.
Okay. There are a few more questions. I request members to excuse us for the shortage of time, but I think it's been an interesting discussion. What we will do, as earlier sessions, we'll try to compile these questions into some form of a publication, and Balu will require your support to get those answers to these queries so that we can give a short publication. Chairman is planning to see if we can have the publication by 1st of July. So you'll have to give us some time for running it past study groups also. So I know you're a busy professional, but a little bit of time from you will be very helpful. Just one parting comment from me is, Balu, we have this expression called minority shareholder and all, but somehow that expression is something I'm not a big fan of. Of course, in accounting, we have moved from the term minority to non-controlling interest. We don't use minority anymore. And in fact, even there, I would prefer majority and non-majority shareholder. So it's like true, not true versus lie. Not true and lie are not the same. So I would prefer, Anil mentioned at the start, that minority shareholders today have a reasonably big say. Sometimes you really don't know who is actually controlling who.
No, if you follow the US, then they are becoming majority. And even here in India, exactly. Minority shareholders are becoming majority. So that's an interesting one.
Exactly. There is so much of skew towards them. So that's why I am not a big fan of using the word minority. So probably we should say majority and not majority. So that might be a better expression. Over to you, Anil.
No, so I think as always, a fantastic discussion, MPV. Thank you so much for steering the ship. And of course, like you started by saying and introducing Balu, I think been a fantastic contribution to our discussion today. And I think I would definitely take one cue from Balu today, that I think we should try and see if we can do research in the institute to be able to, collect some form of database or reports. And it could go endless. I mean, we could come out with research reports for a particular industry, for a particular case. So I think thank you, Balu, for bringing this out. And I think Sarika here would probably help us to, again, maybe put it in our tracker to see that, we could probably take it as one of our action items. But thank you once again. And I think I would only say that, this becomes more and more interesting. And I think minority is not ending today. Minority valuations cannot end today. So I think over a period of time, we would again request you on maybe a specific point of view around the minority valuations, or as MP would have said it, maybe not really minority, but non-majority. So Sarika, to you, maybe you'd like to summarize and then also announce what is it that we're going to have on the next Sunday.
And also one more action.
MPV, yeah.
One more action item is the guidance note or education material on this non-majority valuation.
Non-majority.
Complex, actually, so complex.
Yeah.
The member should not innocently end up with litigation. So we should try as much guidance as possible.
Yes, Sarika. On to you.
Yeah.
Thank you.
I would start with thanking Balu sir first, because the way he has explained the things, nitty-gritties of minority valuation versus majority valuation and Cadbury case, members have really liked it, and they are requesting for one more practical session altogether on the topic. So they want exactly the practical session, how you have explained, sir. Thank you very much for sparing your time. Thank you, Anil Bhandari, sir, chairman, who has always supported all the initiatives and endeavors taken by Valuation Standards Board and Institute, and MP Vijay Kumar, sir, also for supporting me and in everything what we want and what we want to do for the members. Segal, sir, of course, who is sitting always with me for doing things. Yes, we have to do this, and all kind of supports. Thank you, viewers. We have 6,500 people who are watching live, and they are actively engaged by writing everything. And next week, we have the topic valuation reports, do's and don'ts, exactly what it contains. And the speaker for the session is Sujal Shah, sir, who is again a well-known speaker and 25 years of experience in valuation. Thank you, all of you. Have a nice Sunday.
I think there can be only do's and don'ts only in the valuation reports here. And disclaimers and caveats. So fantastic. Thank you so much once again, everybody. Have a fantastic Sunday and look forward to see you on next Sunday. This is kind of becoming like a Netflix episode, MPV. When Rakesh ji started, he said this episode today. So I was thinking that this is kind of becoming a Netflix episode. So fantastic once again. Thank you,
Thanks,
everybody.
Thank you. All credit to you. Thank you. Bye.
Thank you. Bye.